on. Go ahead. I'd just like to ask the audience, who here has cryptocurrency? Okay, that's about half maybe. Okay, that just gives me an idea of who we have in the audience. So, and by all means, ask any questions as we go through here. I'm quite happy to answer them. If I don't know them, I'll tell you I don't know them. But feel free to ask questions as we go through this here. And at the end, we will, internet permitting, it's a bit dodgy, we'll show you the platform. It'll be the first public showing of it, actually. We'll take you through a workflow of how it can be used. And hopefully some of what we've talked about at the start of this presentation will you'll see the context for it and see it in action. I flew in from the UK yesterday, so I live in the south of the UK. And it was a great opportunity. We did a presentation yesterday. So it's just great for me to get out. It helps me practice my speaking skills to convey this information, and hopefully people will learn something as we go through. So this is really what we're going to talk about today. Just an introduction really to blockchain, cryptocurrency, maybe some things you know already. Hopefully those who haven't got any cryptocurrency, maybe they'll learn a little bit about this. And then at the end, Paul will share with you some of the work we've done and sort of our vision around cryptocurrency and blockchain. So what is blockchain? So if you could take one thing away from this presentation, I would say decentralization. It's building new systems to get rid of intermediaries or third parties, trusted third parties in a lot of different industries. And it's taking existing technology and just bringing them together to create these new blockchains. So decentralization, moving away from centralized one person controlling the system to a network that just works together, basically. So decentralization is a very important aspect I'd like to leave you with. And this is where it really all started, Bitcoin. So back in 2008, this pseudonym, it could be one person, it could be many people, we don't know, they have never revealed themselves. Published this paper around an electronic cash system. So there had been attempts in the past to create sort of digital cash, and there was an issue called the double spending problem, where you could send it to two people at the same time and potentially commit fraud. So what the people behind this, or the person behind this, did was solve that problem through cryptography and network timestamps, and to create a cryptographic chronological order across a network, so you can't break, you can't fool the encryption, and that was a key problem to solve that allowed Bitcoin to rise. And Bitcoin is the application that sits on top of this technology called blockchain. And it started off many years ago below $1. At that snapshot, it's $3.94. Just recently there, the price has risen. And there's many reasons for that. One is the scarcity that has been created through this technology. With Bitcoin as an example, there will ever only be 21 million Bitcoins created in the network, ever. And we're around 17 million generated currently. So as more and more people hear about Bitcoin, as more services are built up around Bitcoin, there's more demand for it. The price will rise because the supply deflates over 4 years. So every 4 years the algorithm changes in the network. And there's an incentive to the miners, which I'll sort of come on to in a little bit. I don't want to jump ahead. But does anybody know why the miners get rewarded in the network?
Because the machines they manage, they solve all the
They solve the problem.
The problems for encrypting or validating the encryption or something. Which
so they validate the transactions, correct? So what the reward is actually incentive. It's an incentive, a security incentive. So the miners are the integrity of the network. They make it all work. And by doing that work, they get rewarded through the issuance of new Bitcoin. And yes, it's quite resource intensive at the moment. It's extremely complex to solve the problem, and it takes a lot of computing power at the moment, which is being noticed from an environmental point of view. You know, it's really a problem for Bitcoin. But I took out of the paper, and I thought these were 3 quotes I think were useful to share with you. This is what it was all about. It was about sending money worldwide without anybody in the way. So I have a real use case for that. My daughter's in the US, so every month I send money to the US through the banks and through a SWIFT transaction, and it takes several days to get there, and it costs me a lot of money to send a few $100. And with Bitcoin or these cryptocurrencies, I can transact globally with the same amount of value in real time, practically, without anybody in the way, from person to person, and that's the power of this technology. So Bitcoin's the application that sits on top of that blockchain. There's other blockchains out there, 2nd generation, 3rd generation blockchains, where you can build new kinds of applications on top, decentralized applications and smart contracts. And there's a lot of innovation being built up on top of these blockchains. So this technology facilitates the creation of new innovation. So yeah, the blockchain decentralization of trust with smart contracts. We have automation, where 2 parties can come together. The funds can be embedded in the contract, and certain conditions are triggered to satisfy that contract. The value that was put into that contract moves from different parties based on how the code is structured. And these slides are slightly changed from a different presentation we did, where we broke down each of the different sections here. So our people working on purely just the applications that run on top of these blockchains and the solutions for the end users. Then there's a whole group of developers and innovators and entrepreneurs working in the middleware and the service space, creating APIs to make the application developers be able to iterate quicker. And then there's the core, hardcore developers working at the protocol level, making sure that the code base is stable and stays stable. And then there's certainly ongoing active research in the academic space. Myself at the master's level was studying blockchain and security. So there's a lot of academic work going on worldwide on these distributed ledgers. So we're not going to go into all those areas in this presentation. I just wanted to put them up there to talk about. So there's a technology now where you can upload a file and it's encrypted and it's stored on many different servers in a decentralized way. The money, you see Bitcoin, how valuable it is at the moment. There's Ethereum, there's about 1,000 more cryptocurrencies out there that people will trade for goods and services. And people are working on identity integrated into the blockchain and smart contracts we'll talk about. So what is this block that we hear? What blockchain? What is the block? Well, the block is simply a data structure in software terms. And if you visually look at a box, basically they put the transactions in to the box, this data structure. And through these miners, these specialized computers that are holding the network together, they do these complex computation to prove mathematical puzzles, I guess, in a simple way. And whoever gets the calculations correct and it fits onto the end of the chain in data structure ways, gets the reward, and then the whole process starts over again, simply. And what happens is when I send a transaction, say from me to Daphne here, A to B, that transaction's broadcast out on the network and there's a transaction pool of all transactions that haven't been validated. And these miners will take them, put them into this data structure, perform the calculation, and if it's correct, it goes onto the blockchain. And that's irreversible. You know, the value transfer from me to Daphne then, and it can't be reversed. And that's done through cryptography and the consensus algorithm that I mentioned, which I think we come on to. And this is another sort of technical representation of what's in a transaction, how they all link together. And at the core of this technology is cryptography encryption, specifically public key, private key encryption. The public key on these networks really is your address, where people would send you money to, that long string of numbers and characters. And you have on your machine, hopefully, or the exchange would have a corresponding private key. And that would allow you to transact or have ownership over the digital asset. In this case, it would be Bitcoin. And again, the time stamping is important. So once something is cryptographically signed, and time stamped, it's very hard to break that encryption to mess with a transaction. To compute one of these blocks, as I mentioned earlier, is so resource intensive at the moment. If you were to go and change some transactions further down the chain, you'd have to recompute that block correctly, and then every single one that has came behind it. So to be able to change that, it's not worth it. The amount of processing power you would need to first change the transaction and compute the hash, but then do every other one to catch up to the head of the chain is just not worth it, especially now with the difficulty it is in mining Bitcoin. And that's what makes it so secure. So I just want to wrap up in this term of the block, if you hear in blockchain. So it's really a data structure, contains all the transactions, usually in the previous 10 minutes in Bitcoin's case, and does some calculations on that, making sure all the hash values are correct, that they link to the previous block, and it's verified. And once it's verified, it's broadcast to the network, and all the other chains import that in a peer-to-peer way, and then they just keep building the chain based on whoever's got the most recent block, and that's publicly viewable information. So, and I thought I'd leave these in just in case maybe I didn't explain some of these terms in the best way. Here are some definitions of what each of these actually mean, and we'll make these slides available to anybody who wants them. You'll easily find similar interpretations of these online. So the blockchain has all these data structures called blocks that capture transactions validated by these specialized computers called miners. And the hashing. So another key part of these blockchains are the algorithm sort of that makes it all happen. How do they agree that the transactions in the particular block that's just been mined, are the correct ones? And it's done through consensus algorithms. And this is a pretty old one. There's actually quite a lot more consensus algorithms, but the main one that was released with Bitcoin and Ethereum was the proof of work algorithm. And that is the algorithm that's performed by the miners to validate the work. And people often say that Bitcoin has no value. How can you just make something out of nothing? I mine Bitcoin and Ethereum and a few other cryptocurrencies, and if they knew the amount of effort that went in to my miner in terms of energy and keeping it cool and just pure raw power to calculate the hash function and contribute to winning a successful block is enormous. I'm in a pool with other miners, and there's thousands of us to break the code just to get that one block, basically. So it does take a lot of work. It does take a lot of energy, and them electricity bills and that hardware cost has to be paid somewhere. The cost has to come from somewhere. And I talked earlier about the deflation. So there will only be 21 million Bitcoin. And what happens is with the algorithm, does a few things. So every 4 years, the reward to the miners halves. So it started at 50 Bitcoin for every block. 4 years later, it halved to 25. 4 years later, it halved to 12.5 or so. In another 3 years, 2 years, it's going to half again. But the compute power is going to increase. But also the awareness, the services, the businesses that are built up around this, they're all going to increase. The demand is going to continue to increase. So in simple supply and demand terms, less are coming into the system. It's getting harder to get them. More and more people want them. And it'll naturally drive, hopefully, up in price, which we have seen over the years. If you look at the chart for Bitcoin price over the years, sure, you'll see big swings. But over the long term, it has trended upwards, currently around 8,000 to 9,000 today. So there are more consensus algorithms out here. Another genius in this algorithm is, in Bitcoin's case, where the block time is every 10 minutes. So if more miners come onto the network, they're going to calculate blocks a lot quicker. So the algorithm will dynamically change how difficult it is to compute that hash, so that it keeps it at an average of about 10 minutes. So if less miners fall off the network, the difficulty will relax. It will be a lot easier, so that it always keeps this 10-minute time frame. Proof of importance is another one that you'll see out there also. With proof of stake, so the proof of work is very resource intensive, especially on the Bitcoin network. Ethereum, the second biggest cryptocurrency out there, I just shut off my graphics cards mining rig because it's not worth it now. The difficulty has risen so hard that you're basically getting less than what you're doing. You're paying electricity. You know, it's costing you more electricity really to run it. So it's been turned off. The proof of stake is where they're all wanting to move to. And it's less resource intensive, so it doesn't matter if you have the biggest resources. That's not what the algorithm looks for. So it looks for how much of the cryptocurrency you have staked, saved in your wallet, contributing to the network. How long has your wallet been online, and other factors. And it'll randomly select a particular wallet, and it'll do the proof of work calculation and get the reward for the block. It doesn't go solely on pure compute power. So this benefits those who hold a lot of the cryptocurrency. So if they're staking a lot more, the chances of them being selected to mine a block is more favorable, and thus they will get more blocks over time, more rewards, and they'll get a better return on their investment, their stake essentially. Whereas this is the opposite. It's just who has the biggest hardware. And they all have some different attributes. And there's many more, as I say. This is an old diagram. But this is a core feature of blockchains, is the consensus algorithm. So if you're looking at projects, take a look at what kind of consensus algorithm they're using out there.
Yeah, what's your opinion on the proof of stake algorithms?
I'm waiting to see what Ethereum does.
Do you think they can pull it off?
So they're way behind. So we were expecting proof of stake in January, and we're now midway through the year, and we haven't really seen anything from it yet. So in terms of a software delivery, they're way behind on their deliverables. Innovation's happening, and that's one of the core issues in the space. And you read a lot of articles out there from people who are not technical, who are not coders. They forget that these are software projects. They're real people coding on them. And if you have experience in delivering software projects, you know that an estimate will always be a lot more than what it is. Rarely is it accurate, believe me, in the professional space. Estimates are very rarely accurate in software terms. You always want to put a bit of padding in. The 6 months behind I'd like to see it because it's important for the Atlas stuff that we're working on. So we forked the Ethereum code base. We created our own with different parameters. And we'd like to move to proof of stake, but we need to see how Ethereum handles it first before we try and adopt some of that code. I'd like it because proof of work, as I said, it's so resource intensive. This is a better option, but it needs fair distribution of the cryptocurrency, or else it only favors the big holders.
What do you think about delegated proof of stake against proof of stake?
Again, same thing. Everybody's trying to move away from the resource intensive aspect of this. If you've ever seen the videos online of these mining farms, they're huge buildings with just miners in them, and they're just crunching the hash 256 algorithm. You know, this is doing nothing positive for the environment, draining all that electricity. So I think that a lot of people in the space are moving to these kind of proof of stakes, delegated proof of stake. You know, they all want their own little slant on it, right?
But it doesn't have the work that it requires. For example, in Bitcoin's case, where they have proof of work, they have money running to the system all the time because they have to pay for the electricity and so on. But in proof of stake's case, you just hold the currency. But if the currency's value goes down, what will happen then?
That's the nature of the space. It's really the volatility in the space today is something to be conscious of. You know, it's not common to see 30, 40, 50% swings in a cryptocurrency. You know, from a tweet, in some cases, it's terrible. But again, look at it from a technical point of view, and that's what I do. Is I look at GitHub. I'm in the developer chats. I'm seeing what the developers are talking about, what they're working on. You can watch their stand-ups and how they're developing this stuff. They're open and transparent. So I try not to get too caught up in the media cycle around cryptocurrencies, because sometimes it's often a journalist who maybe knows about the space but doesn't have the technical understanding of the project. And you get a lot of speculators also. So I tend to just stick to the developers. I've developed a lot of projects myself. I know how they go. So these will probably change in the future. So we've got a third generation one, like Tangle, that is different again for Internet of Things and sort of micropayments. There will be others. It's innovating so fast, this space. We're already on a third generation blockchain in just a few years. These may well change again in the future. They may come up with better alternatives to this here. But it's just an evolution, I guess. Proof of stake, delegated proof of stake, proof of importance is another one. I think it's the NEM project, is it? Yeah. So I guess people seeing the weaknesses in others' projects, that's why we had the Ethereum. They've seen some weaknesses in Bitcoin. They said we can do much more. We can do decentralized apps. We can do smart contracts. And the guys in Bitcoin are like, no, we want to just keep it secure. Yes, we could do that, but we're not. We're just going to keep it secure. Whereas Vitalik and them guys, they had other plans. You know, and everybody wants their own stake in this landscape because it's brand new. So proof of stake, delegated proof of stake, you know, they're all trying to do their own, be famous. So when you're looking at blockchain projects, when you're sizing them up, you're looking at the team behind it. One thing you want to have a look at is what consensus algorithm are they working on? Are they planning on changing in the future? Why is that? When is that? Because it all affects the price potentially.
What do you think is the consensus algorithm of the future? What combination?
I do like the Tangle if it stabilizes. I quite like it. So it's smart contracts are coming soon. I like the Tangle in the case of IOTA because if I send some IOTA from me to you, again, there's no fees in the way. Whereas in Ethereum or within Bitcoin, there's a little transaction fee that goes to the miners. So with IOTA, there's no fees. You get exactly what I send. So I quite like IOTA because it can be perfect for micropayments and also perfect for pretty low resourced economies where you don't want to hit them again with a fee like in Bitcoin or Ethereum. So the Tangle, I think, is pretty interesting. So just before we move on to that, any questions, further questions? We'll continue on. Cool. So cryptocurrencies. So for those that don't know, they're essentially just digital assets using cryptography, where you can stake an ownership to it, and only you, because you have the private key, essentially have ownership of that. The systems that they operate in are typically decentralized, and the cryptocurrency is the application on that particular environment that's used for a means of exchange of value. And again, cryptography is at the heart of it, public and private key encryption. And again, a quote that I just took out of that paper, and I do recommend this paper for those that have not read it, because it really set down the vision for some of this technology, and it's linked up there. So for most people being introduced to cryptocurrency, they would typically find their way to a cryptocurrency exchange. In the early days, there were not many out there, and the ones that were more than likely got hacked, like Mt. Gox. There's been massive hacks on cryptocurrency exchanges, with tens of millions of cryptocurrency were stolen in dollar terms. Tens of millions of dollars worth of cryptocurrency were stolen. But what the exchanges have done is they've seen an opportunity in the space where people want to get in on it, but they're maybe not technical enough to get down into the wallets and the keys and sometimes the command line in some blockchains. So the exchanges have made it easy to log in, just like you would with any other financial product. You put your credit card in, you validate your identity, and then you'll just go buy an amount, and it'll charge it to your debit card or your bank account. They've made it really easy for people to get into holding cryptocurrency. Because they are taking your payment details, they are bound by regulation. So they'll ask to validate your ID just for anti-money laundering purposes. So if they're ever questioned, they've done the right checks to prevent money laundering. But yeah, this is the first port of entry for a lot of people. But I would say that you'd never want to hold your cryptocurrency in an exchange because they get hacked, or they can go out of business and they might lose your money and you might never get it back. So usually I have a little pot in there for my mining activity, and it's only a small amount sometimes, so I don't mind if it ever got lost. But I wouldn't hold a lot of crypto in an exchange. It would be too risky still. And again, they are sort of getting in the way, like a middleman, So what's come out as a result of these cryptocurrency exchanges that typically add on a fee, right, is decentralized cryptocurrency exchanges through the use of smart contracts. Again, taking out the middleman. The person that wants to sell sells it via a smart contract, and someone else transacts without anybody in the way. So that's the trend, moving again to decentralization. And what they've done recently, a lot of these exchanges, is they've started to put in minimum thresholds. So to get onto one now, you must deposit 5,000 euros, for example, as a barrier. And same with withdrawals, they all differ. You're just putting barriers in the way again. We'll show you a demo potentially at the end here. But you hear the term wallet, where you hold your digital assets, just like a physical wallet holding your bank cards and stuff. These kind of wallets is where your private keys will be stored, and you can deposit into them, you can send out of them, you can have accounts that are multi-signature where multiple people are involved. So it might be you and some friends invest some cryptocurrency, and no one can transact on it singly. They need the multiple signatures to authorize a transaction. There's some features that come into the newer wallets. But it really, at the heart of it, is public and private keys. It's not really new technology. It's just being put together in this interesting way. It's give rise to a lot of this innovation. So smart contracts, has many people heard of smart contracts here? No? One person? Two? Three? Okay, cool. So where shall we start? Smart contracts. So smart contract is essentially a piece of code, and we're going to look at one at the end. I'm going to show you a real one that works. It's a piece of code that defines some logic and some actions to be met, and when they're created, brought to life, they are sent to the blockchain. So they live on the blockchain. So no matter which node you get to, you can interact with this contract if you're authorized. And what you could do is you could send in cryptocurrency into this wallet, or to this smart contract. So you can say, I want to create a work contract, for example, and I want to do some, need someone to do some work for me, and I'm going to pay them 100 Ethereum, for example. So you can deploy that contract to the blockchain, put in the 100 Ethereum, and someone can then take that job by interacting with a contract. Say, I'll accept that job. It puts his address in there. So now they're both bound to the contract. When the work is delivered, the freelancer could trigger another function to say, look, I've finished the work, change the state of the contract to be delivered, from in progress to delivered, for example. And then when the client reviews it and he goes, yeah, I'm happy with the work, great job, he can then trigger the contract to say, job done. And at that point, the logic could move the value of the 100 Ethereum from the client to the freelancer in an automated way without a third party. So they're programmable contracts that you can link up existing web applications. So to the end user, you're going to see a normal website or an application, for example, like these taxi apps that you can get, for example. You know, you get in, you point to point, and then you pay with your card or whatever. Well, now it'll be cryptocurrency. There'll be no central Uber, for example, or Lyft, or whatever these companies are called. You know, there'll be a load of smart contracts, but it'll be delivered in the same way as Uber or Lyft or these other companies. The end user experience is going to be very natural to the mobile and web applications you have today. But when you trigger actions in them, they will call to functions in these smart contracts on the blockchain to change the state, to move value in an automated way without a third party in the way, taking a fee. So they're really powerful, and they're giving rise to lots of different interesting use cases. And decentralized applications. So these are as I mentioned, they look like web applications to you, but behind the scenes they're interacting with smart contracts. So it doesn't matter if the node that it normally connects to is down, it can connect to any node, and that data for that contract it can still interact with, and that's the power of these decentralized applications. It's very hard to take them down, censorship resistant. You know, take one node down, it can still access it from a different node. And you don't have to interact solely within, say, a web application, because the code's on the blockchain. If you have a specialized wallet that does interact with contracts, you can interact directly with a contract if you knew what you were doing. You don't have to go inside someone's application, because if you have the private key for the wallet that's in the contract, you can just call it from the command line even, as long as you're authorized. These are really powerful, and we're going to see a lot of innovation around smart contracts and decentralized applications. Some examples here: self-executing, automation. It's really getting rid of those intermediaries. And you can think of an industry out there where there's someone in the middle taking a fee. It's probably ripe here. In the taxi example, you know, with the code deployed to the blockchain and some open source code that does the same kind of thing with maps and stuff, there's no big back-end centralized systems needed. All the things can be served up as smart contracts. I need to go from A to B. It deploys as a smart contract. The driver has a filter that only shows him these kind of smart contracts. They're taxi type contracts that are filtered based on GPS of his phone, for example. You know, they filter the right jobs to him quickly. But it's all done through smart contracts. It's just direct between the driver and the person. There's nobody else in between. And that's where we're going is decentralization. And it's more efficient as well, because there's no need for all this big hardware from a centralized IT point of view. If you're running an open source peer-to-peer network, the nodes will be all over the world. You know, you're sharing the infrastructure costs. The miners are doing the work, and they're getting the reward for it. Some use cases. Yeah, we're starting to see blockchain use cases for almost every industry: energy, security, supply chain, you name it. There's people looking at blockchain. Can it help? Doesn't help in every case. It's not a technology that'll solve every problem, but there's quite a few out there. If you think, why am I paying this fee? Why is this taking so long? You could probably see if you could make it more efficient through the use of blockchain technology. A lot of the blockchain code is open source, most of it. You can easily fork it and make your own, customize it how you want it, build your own ecosystem, build your own cryptocurrency to put behind your own online environment. If you're doing a game, for example, maybe you create a blockchain with some currency that's used within that particular game, or on-player, multiplayer online world type thing. You can create your own currency and integrate it, and it can have the properties that you define up front, such as the deflation of the reward of new coins being generated, unlike central banks, where the central bank can just print more money when it wants and deflate the currency, or inflate the currency, sorry. So one of the biggest issues, and another use case, one of the biggest issues in this space is talent. It's anybody that can code this stuff is already coding it, and they're already getting well looked after. And the people with the skills and the attitude and the passion really to get stuck in is rare. And every blockchain project out there will tell you that they need more talent. They need more people to join them. And the work is out there. The code's out there on GitHub. You can easily sign up, fix a bug, speak to the developers, and get to know them. They're pretty approachable. But talent is the biggest thing. There's many projects out there that just can't come to market quick enough because they haven't got the developers to execute on the plan. And I'm just going to wrap up here. So blockchain, it's distributed in most markets out there. Finance being a big one to crack. Systems are becoming more democratic. So they had this concept with smart contracts around decentralized autonomous organizations. So you can create an organization essentially with rules embedded in the code, and people can become shareholders, for example, of that organization by transacting with it with some currency, and you can give them so much of your token for that transaction, and they can become a shareholder. Being a shareholder, they could make a proposal on what to do with the funds in this organization. And the logic could have in it that when we have a certain majority, for example, of all the shareholders that can interact with the contract, they can approve what to do with those funds in an automated way without a central governance. So that's an area of interest, creating these systems of autonomy. With blockchains, transparency is also a big one. Data privacy. We just recently had GDPR legislation come through for data privacy. So while the data on the blockchain is public, the use of cryptography really secures it. So we might not know who these addresses belong to, but we can see that that transaction has actually happened. Securely, decentralization I've mentioned, highly secure. So there's multiple layers of encryption here. And cost saving is a big one. So why would you stack out a big server room now with all this custom equipment and to run this big scalable system when with blockchain in a decentralized way you can leverage the nodes all over the world to share the code. So deploy your contracts to a public blockchain that runs all over the world rather than have it in one centralized place, which is pretty costly. So there's a lot of savings to be realized in enterprises today. If they can create new applications that are built on the blockchain, they can reduce costs quite a bit and increase revenues in some cases. So that's the first part of the presentation, really on blockchain and cryptocurrencies. Just an introduction. If there's any questions on this part before we move on. If not, we'll just do a best practice run here. No? Okay. So for those who haven't got some cryptocurrency, or for those who already have, these are just some best practices and some guidance in the space. So if you're signing up to any website related to cryptocurrency, make sure that the website has two-factor authentication and enable it. If it doesn't force you to enable it, I would say enable it right away, because passwords will get cracked and compromised. But if you have that second layer of authentication, at least if your password's stolen in some way, they haven't got your phone, hopefully, or your second layer of authentication. There's a lot of scam websites, and some of the scam websites that I've seen are really good, extremely well put together. If you were not looking for the signs, a lot of people would just sign up, because these criminals will steal pictures from LinkedIn and they'll link to people on LinkedIn, and they're nothing to do with the project. But just because someone has a profile on LinkedIn, they're just taking the URL to give that site legitimacy. So there's a lot of scam websites out there. Look for the reviews. Look for people who've tried and tested this stuff. And on your wallet, so it's always good to have a wallet, a reputable one, on your own machine, where you have control over the private keys. Because, as I mentioned, exchanges have and will be hacked. It's only a matter of time before a vulnerability is discovered that allows someone to compromise it. Some exchanges are much better than others. They have the investment to put into the security, but I wouldn't leave anything in an exchange that you weren't afraid to lose it. Periodically, you can just pull it off the exchange to your own wallet. You can even print your wallet now out on paper, and you can file that away, and you don't have to have anything digital. You can have it as PDF, print it off, and then when you want it back, it's a QR code, and you just scan it back in. So it's pretty easy. And the volatility, or the fourth one, volatility. There's a lot of volatility in this space. There's a lot of speculators in this space as well. People who are not necessarily behind the projects from a technical point of view, they just want to make money. Where there's others in the space who believe in the project, who believe in the team, who want to see the solution come to market. But then you've got all these people wanting to make money, so you definitely see massive spikes and drops, and that's part of this space. It's still volatile. It reacts. The news has a big impact. The cycles of the news are very short. So if you're ever in the space and it drops like 30%, don't be so shocked, because it's normal. I'll just hang in there, because it will come back up again at some point. And liquidity, yeah, so it's getting better. A lot of the exchanges now, you can withdraw your money pretty easily. But as I said, they've started to put in these minimum thresholds to try and limit the movement sometimes. especially when there's big runs. We just took these quotes that we found, Deloitte. So Deloitte is a big effort in this future of work term, this Industry 4.0, where automation, this fourth industrial revolution that we're on, these technologies coming together. We believe in the future, not many people will want to commute to work, sit in traffic, as I do in the UK, for like over an hour most days, both ways. It's soul destroying. I think in the future people will want to work, and I think the data that we have supports it, especially in the US. There's more and more increase in people being self-employed, working when and where they want, and hopefully with what we're doing and with some of the research that's coming out of Deloitte and World Economic Forum around the future of work, I think we're aligning to it. We're trying to build that platform that will support this shift using these technologies. Okay, so that's my presentation. Hopefully I've shared with you some things that were useful to you. If you want to ask any questions, I'm open to any questions at all. If not, Paul's going to take you through a short slide on some of the work we've been doing with this technology, how we've taken what was out there and brought some vision to it for a whole different project. After that, we'll probably do a demo, show you what we've actually been doing.
Thank you, Patrick. Please give a big round of applause for Patrick. All right, let's get started. So, Atlas.Work. Atlas.Work is the first decentralized freelancing platform with a machine learning ecosystem on the blockchain. And the beauty of Atlas.Work is it's based on the freelance economy. So first of all, I would like to know if any of you have used an online freelance platform or have been a freelancer, basically where you do your own job, you're independent yourself, you control your own time, and you set your own deadlines, basically. So, a few, yeah, so very limited. So, all right. So the main features of the Atlas.Work platform is based in cryptocurrencies. So as a freelancer, you would receive payouts in cryptocurrency, and as a client, you would list a job in a value of a cryptocurrency. The platform accepts many different cryptocurrencies like Bitcoin, Ethereum, and our original cryptocurrency, the Workcoin. Through the platform, we remove basically the intermediary, the middleman, that would face problems and barriers on the common freelancing platforms. The issue with the main freelancing platforms like Upwork.com, Fiverr, and freelancing.com is the commission rates. They would charge a freelancer, and even a client as well, commissions that are considered way too high for boosting and the growth of the freelance economy, because freelancing is really giving away the dependency back to the freelancer, making them independent without requiring any kind of employers. So they work directly through this ecosystem in connections with the clients. So the platform, as mentioned, is a machine learning ecosystem. Machine learning is basically artificial intelligence. What we do is we use all the information that is being transmitted through freelancers and clients on the blockchain, because all of these operations, and we'll show you live after, is happening through a blockchain, through smart contracts, where we write in our rules and we can basically set guidelines for freelancers doing business with clients. Also, we kind of apply this decentralized authority for the platform. So on Upwork.com, which is the market leader of online freelancing, if you have an issue with a client as a freelancer, or if it's vice versa, then you would need to be dependent on the platform's kind of final decision. So you would be in contact with the platform. The platform will then analyze the jobs and the communications among a freelancer and a client, and it will take a decision, who is right or wrong. And this kind of brings a central authority to the space of freelancing. And because we want to really be decentralized, and even us as a company, we want to have the minimum impact of authority on the freelance ecosystem, what we call kind of dispute resolution system, so where a freelancer can basically discuss a dispute with a client, this dispute and arbitration is done through the community of freelancers. So we give the opportunity to freelancers to kind of vote on the outcome of decisions on clients and freelancers, where they can study the work and decide who is right or wrong, because it happens and it's a big problem with freelancing. We also have the career guidance. So when I was talking about machine learning, we kind of analyze the data going in and out of the blockchain, and this data, we use it as kind of a career guidance for freelancers. What this does is basically a freelancer would receive a notification that a new job is basically sent out to the blockchain. And the reason you would receive this notification is because the machine learning would identify all the right skills that it would require for a freelancer to complete this job. Hopefully in the first and second years, of course, we'll just gather the data, and after that we can apply it to the full platform. We also have the integrated wallet and digital asset exchange. So because we operate with many different cryptocurrencies, we need to provide kind of liquidity to our users. And that's why we don't want to just impose one cryptocurrency. We want to impose many different cryptocurrencies because they all work around kind of a different blockchain. So by having all these cryptocurrencies, we can offer digital asset exchange, where we allow the freelancer to exchange his different digital assets, and then he's free to kind of manage his own portfolio. So the core kind of competencies of Atlas is intelligent, decentralized, and secure. Because all of these operations is through the blockchain, there's no middleman, there's no central server, so there's no vulnerability to hacking. So all the sensitive information, all the kind of payment information that is stored on the blockchain is 100% secure. We cannot even access it as kind of an external party unless it's authorized for a smart contract. So even us, as kind of the company, we have a lower kind of authority than you would have on a private platform that is run on just normal servers. And we have also created the Workcoin. So what we did, and I think Patrick briefly mentioned it, is we forked Ethereum back in October 2017. And Ethereum back then was proven to have one of the strongest kind of technology in terms of the updates they made with the smart contracts and also the potential release of proof of stake. Because ultimately, we want to move to proof of stake with the current Workcoin, as it allows for instantaneous and free transactions. But what we did is, by forking the Ethereum blockchain, we have created our own independent blockchain. And with this blockchain, it allows the possibility for freelancers to build decentralized applications on this blockchain, where by building these decentralized applications, they can create their own kind of ecosystem. And this gives kind of this independence to a freelancer. So let's say you're an engineer, software engineer, and you really want to work under your own office. So that software engineer would create his own little ecosystem for themselves as a dApp, so a decentralized application, and he would connect it to the Atlas blockchain. And by having it connected, he can exchange, use the APIs, so kind of the source for us to transfer the funds to his accounts. But his account is always on the blockchain. So even if he doesn't use the main platform that we will show you after, it will always stay in this, within this one ecosystem, which will kind of assure the security of the funds, will assure kind of the fair treatment of the freelancer and the client, all within the same ecosystem. And it also gives us full independency compared to the Ethereum blockchain. Because I'm not sure if you guys are familiar with ERC20 tokens. The tokens are created under the Ethereum blockchain. These guys basically, it's very easy. I mean, it takes 15 minutes to create an ERC. So you can create your own token through the Ethereum blockchain. But you'll always be kind of operating on the Ethereum blockchain. So all transactions will need to be paid kind of in Ether for the miners to approve your transactions. And these projects are kind of independent to Ethereum. So of course, if the technology Ethereum is not going in the best direction, you could say, then it will affect all these projects. For us, by forking Ethereum, we're able to just build on it and just keep building on top of this code. And then we're also able to decide when we want to move to a new consensus protocol, like proof of stake, if we believe it's secure enough and it's reliable. So that's kind of the global vision of Atlas. It's global accessibility, quality assurance, carrier guidance, decentralization, work provision, autonomous, all within this one optimal freelancing ecosystem. The platform charges minimal fee for commission. We just kind of charge a flat rate of $2 on any withdrawals. So if a freelancer uses work as a way of payment on the platform, we will not charge them anything in terms of commission, only a fixed US dollar kind of applied value to a withdraw from the platform. So let's say if a freelancer has kind of done, let's say, 5 different jobs on the platform over a period of a month, if he wants to be paid in our own cryptocurrency, in Workcoin, we would charge 0% transaction fee. And when they withdraw the funds all at once, we only charge a $2 kind of withdrawal. So when we compare to 20% transaction fees on other freelancing platforms, we do disrupt this market. We do make a big kind of impact on this because freelancers, like even Uber drivers, as we talked about, they are being charged crazy fees. Also, the transaction time takes quite a long time, 4 to 5 days, if I'm right. And we just kind of try to give more authority to the freelancer because freelancing is really working independent, working for yourself, and yeah, it's an economy that's growing at a very fast rate. And we always like to apply the future is decentralized, and thank you very much. That's the end of our presentation. If you guys have any questions on Atlas, yes, Elizabeth?
One question. The freelancers that sign up in the identification process, do they have to have a VAT number?
No, they don't. It's very kind of private to the freelancer because all information is stored on the blockchain. So we don't even need to apply kind of KYC regulations because the funds are kind of earned by freelancers. For a client, of course, he would arrive on the platform and he would just connect his funds to one of the external wallets, depending on the cryptocurrency he wants to use. But they don't require any kind of regulations or, like you said, VAT, because it's not being kind of put to place in the crypto space, as you could say. So, for example, maybe in a year or two, once the government has kind of learned how to, analyze the blockchain, how it can have an impact on work, then maybe we could expect certain regulations, of course, because they have to pay the taxes. And but for now, it's not the case. So,
But you are preparing for that moment that regulation kicks in?
yes, we will have to apply definitely, because it is a workspace and it have to apply taxes, and of course, we'll have to look into it.
Also, a point around Upwork, for example, one of the bigger competitors. To get on and be a freelancer, you have to have a bank account.
Indeed.
There's so many people around the world that can do the work that maybe don't have the easy access to bank accounts that we do have in the West here. They can all now just sign up and start earning cryptocurrency, and then using that cryptocurrency to transact globally with the same purchasing power as the rest of us. So we think it's going to be really helpful to those people that are unbanked at the moment.
So this is one of the first kind of prototype of the platform. So this is the first ever public showcase. And also we are the first ever freelancing platform with a complete back-end ecosystem based on the blockchain. So as you can see, this looks, you could say, basic, but we'll show you in a minute the back-end, so the coding of the main codes, how it's always linked on the blockchain, and the kind of the creation of all these smart contracts. So any features that we would trigger as a freelancer or a client, it would send a smart contract. So we'll show you the way it's sent.
Yeah,
but
so we'll take you on a little tour again. This is all still in development, so it's not publicly out there at the moment. But we've been testing and we're almost ready. We'll give it another polish in terms of some of the colors. We'll work out some of the UI bugs that we have, and then we'll release it. We always like to keep the current price of Bitcoin, because in the crypto space it sort of fuels all these other alternative coins. So just keep an eye on it, because if you're a freelancer, Paul said, you're managing your portfolio, digital assets, you might see that the prices of Bitcoin drop real quick. You might want to retain the dollar value, and you might want to come back quickly. But we'll show you what we've been doing, and then we'll show you a real smart contract, for example. So essentially, you'll have a profile, you will fill that in with your rate, and people can come and view your past work history, for example. To browse for projects, so we have some projects here we were testing with. Hopefully, this is a live demo now. I know how live demos go sometimes. We tested it a lot, and then on the day, it often doesn't go too well. So let's see if it holds up. So I would have selected this job that was posted. I would want to do it. Maybe I want to say I'll do it for a certain amount. Say, you post it for that one 10,000. Maybe I want 20,000.
So as you can see, work is the original cryptocurrency that we are creating through this ecosystem.
It's worth more. Right. So.
And as soon as we click send, it sends it through a smart contract. And then basically, if the client accepts the kind of freelancer's offer, so which I can actually do now.
Paul will get the opposite end of that, so he would have to say, agree to my proposal. So I've said it's worth 20, for example, for this particular piece of work. He would have to agree to that. And at that stage then, so when the job's posted, for example, the idea is a smart contract that also gets deployed, and the amount is withdrawn from that person's wallet from that particular job. Then, when I, as a freelancer, submit the proposal, get accepted, my address is added to that smart contract, and the two of us now, our two addresses are embedded in there. So when actions are performed here, so I'll say when the work's being delivered, for example, again, as I mentioned earlier, it'll trigger the smart contract function that will show you. And to the end user, you're using a website, very familiar, but behind the scenes, it's reaching out to a blockchain node that's currently running as part of the decentralized network, and it interacts with that. All the code is stored in the state, stored on the blockchain. Paul, would you like that?
Yeah, I'm having issues with the Wi-Fi. It logged me out somehow. Yeah.
While we're waiting, I'll come back here. So the wallet. So obviously, you need to get funds in here. So at the minute, so what we should see here is the current prices of these digital assets. So we've got some issues around the right, but essentially you'll see the live prices here. These will be your own wallets within this particular decentralized app. This is a dApp, for example. Looks like a website. It's a dApp. You see that I've sent in a transaction earlier. From my wallet on my computer, I have sent it to my online wallet within this particular dApp, so that I can then maybe post some jobs or use it.
Yeah, I apologize. The internet is a bit slow. It's not loading.
Unlike most exchanges that you would buy crypto on, there's a way for you to get funds in. So we talked about the public private key. Here's the public part. When I want to send a transaction, I'm going to try and do one, please. It holds up here. I just take the address of where I need to send to, and execute the transaction. It goes to the blockchain. Miner does its thing, and then when we go to accounts, that there obviously change special deposit and so on. But now we see the values coming out there. They're going to the blockchain. They're seeing what I have in that wallet. The infrastructure behind it, there's no centralized server. It's a decentralized network that we're connecting to and interacting with. And the values and the information is stored.
I think it shows a backend already.
Did you do it?
I'm just waiting. Okay,
Right,
so I'm in.
So one murder, I think it was you. So as a freelancer, I was in that one. Okay. So there's a client in there.
Yeah, I got it. I can accept it now.
Okay.
All right. So now I'm accepting his proposal, and as soon as I accept it, it's going to go through the blockchain as a smart contract. Then we can show you within the blockchain.
So these are some of the ones we did earlier. So here's one that hasn't been accepted yet. This is the opposite.
Okay, it's accepted.
Right. So the one I accepted earlier, this one I haven't. The would work smart contract gets created, it goes live, and the two people are then locked in my contract. So that is, I guess, just an overview of where we are.
It's on the blockchain now.
So short demo, we will be finishing some of the issues that we have, and then we're going to deploy it. Release people can start to. Some of these folk here in the room are going to market the IBO campaign, the initial value offering. So we'll post all the jobs here that you can do and receive some of the cryptocurrency native to the blockchain that's used here, the Atlas blockchain. And as people do work, it's a way of distributing the token out there. No matter what they can do, I'm sure there'll be a job for someone. And then we have other cryptocurrencies in there already, but because of the security, we don't want to enable them just yet. So, for example, Ethereum has been working, but I've disabled it at the moment, and we'll enable them one by one as when we're sure and confident that the security has been thoroughly tested. Because we don't want to be people putting Bitcoin and then other valuable assets in there, and then the site get exploited. This application. So that's.
You can show if you approach
it, I guess. For the demo. So let me show you what else we got up here. Smart contract. Very, very simple. All our code as well is on GitHub, so it's all up at GitHub. You can get on and review it, and you can contribute to it. It's public, it's open source. The contract looks like this. It looks very much like JavaScript, and you declare some variables to hold information. You define the different states of the contract here, and then you can trigger actions to move the contract into different states and build some logic around what state is the contract in. You create these modifiers, so these are simple ways to control who can access a function. So there are functions there that I only want the worker to call, or the client, or Atlas in terms of dispute resolution. You define a couple of events, so the work's created or aborted, it's been cancelled. The job be confirmed, so a freelancer has accepted, that's an event. The work is received.